All right, listeners, you send in some really interesting stuff about UK interest rates. And,
Yeah.
well, we're diving deep into some predictions for what might happen.
Yeah, we've got some heavy hitters like Goldman Sachs making some pretty bold claims about Bank of England rate cuts.
Oh, yeah, and we've got some fresh inflation data from Sky News, too. This is going to be a good one.
Buckle up.
So Goldman Sachs is saying we should expect way more rate cuts than just about everyone else is predicting.
Right, they're definitely going against the grain here.
Can you break down why they're thinking that?
Well, a big part of it is how they see the UK economy shaping up. They're projecting growth to be just 0.9% in 2025, and that's significantly lower than the 1.3% consensus.
Okay, so they're saying the UK economy is going to be kind of sluggish. But hold on, doesn't that usually mean higher interest rates, not lower?
You'd think so, wouldn't you? But the Bank of England's main goal is to keep inflation under control, and Goldman Sachs thinks inflation's going to soften in the medium term.
Oh, that's interesting. But wait a minute. Sky News just reported that UK inflation actually fell to 2.5%. Does that change anything?
Well, it's certainly a twist.
Does it support Goldman Sachs' view or?
It's not quite that simple. We need to look at the details. The drop in core CPI is a positive sign. That's the inflation figure that strips out volatile things like fuel prices.
Right, core CPI. So that going down is good, right?
Yeah, it suggests that high inflation might not be as ingrained as some feared.
So does this make Goldman Sachs' prediction more likely?
Well, the markets seem to think so. There's definitely been an increase in the expectation for a rate cut in February, which could be the beginning of those deeper cuts Goldman Sachs is talking about.
Okay, so things are moving in that direction. But I'm remembering that back in December, some members of the Monetary Policy Committee actually voted against a rate cut. They were worried about the economic outlook.
Yeah, that adds another layer to this whole thing. There are definitely risks to cutting rates too quickly. It could actually reignite inflation.
Oh, so it's kind of a balancing act for the Bank of England.
Exactly. They need to find that sweet spot between stimulating the economy and keeping inflation in check.
So we've got Goldman Sachs saying cut rates, some MPC members saying hold steady, and then this unexpected inflation data thrown into the mix. It's a lot to process.
It really is, and it highlights that even within the Bank of England, there's a range of opinions on the right way forward.
Makes sense. So help our listener out here. Why should they care about all this interest rate back and forth?
Because these decisions have real-world consequences. Interest rates affect borrowing costs for everyone, mortgages, loans, even your credit card.
That's a good point. So if Goldman Sachs is right, and we do see these deeper rate cuts,
It could make borrowing cheaper, but it could also have other effects, like impacting inflation and the value of the pound.
okay, so there are potential winners and losers depending on how this all shakes out. So let's go back to Goldman Sachs for a second. What are they seeing that's making them focus on this weaker UK economic growth?
Well, one thing they're highlighting is a potential slowdown in household income, and that could lead to people spending less, which would impact growth. They're also worried about global trade tensions hurting the UK economy.
Right, those trade tensions. Didn't Sky News mention something about that too?
They did. They talked about how rising inflation in the US could have a ripple effect on the UK.
So if prices go up in the US, it could make imports more expensive for us here in the UK.
Exactly. It's all connected.
Wow. So we've got Goldman Sachs making these predictions, the market reacting, and differing opinions within the Bank of England. This is like an economic thriller unfolding in real time.
It really is. And the best thing you can do as a listener is to stay informed. Keep up with the economic news both here in the UK and globally.
Knowledge is power.
Absolutely. The more you understand what's happening, the better decisions you can make.
Okay, so we've set the stage here. We've got a good grasp of the different perspectives. But we're just getting started. In the next part of our deep dive, we're going to explore the potential consequences of these interest rate predictions.
We'll look at what it could mean for your personal finances, your investments, and the broader UK economy.
So buckle up, everyone. It's going to be a wild ride.
Yeah, get ready.
All right, so we've talked about all these big picture predictions, but let's get down to brass tacks. How could these potential rate cuts actually affect our listeners?
Well, let's imagine you're thinking about buying a house. If the Bank of England does lower rates, like Goldman Sachs is predicting, it could mean lower interest rates on mortgages.
Oh, wow, that would be huge for anyone looking to get on the property ladder.
Exactly. It could make buying a home much more affordable.
Okay, so that's good for potential home buyers. But what about people who already have a mortgage?
Good question. It might be a good time to look into refinancing. You could potentially lower your monthly payments or save money over the life of your loan.
Right. Refinancing, that's always something to consider when rates change. But are there any downsides to rates going down? Any risks our listeners should be aware of?
Well, one thing to keep in mind is that lower interest rates can sometimes lead to higher inflation. If it becomes too easy to borrow money, people might start spending more. And that increased demand can drive up prices.
Yeah, that makes sense. So the Bank of England has to walk a tightrope.
Exactly.
They want to stimulate the economy,
Yeah.
but they don't want to let inflation
Yep.
get out of control.
It's all about finding that delicate balance.
I'm glad you're here to help us break all this down. It can be tough to understand how these decisions made by big institutions actually affect us.
Well, that's what we're here for, to make economics relatable and understandable.
Speaking of relatable, how might these potential rate cuts affect someone who's thinking about starting a business?
Oh, that's a great point. Lower interest rates would definitely make it cheaper for businesses to borrow money.
Right, so it could be a good time to take out a loan to get your business up and running.
Exactly. Or even to invest in expanding your existing business.
So there are opportunities here, but also potential risks. What's your top piece of advice for our listener as they navigate all this economic uncertainty?
I think the best advice is to stay informed, stay prepared, and don't be afraid to ask for help. There are so many resources available to guide you.
You're right. There's no shame in seeking out expert advice when it comes to your finances. Now, before we move on, I want to go back to those global trade tensions we talked about. We discussed how they could affect the UK economy in general, but can you explain how they might specifically impact interest rates and inflation?
Sure thing. It all comes back to uncertainty. When there are trade tensions, businesses become hesitant to invest and expand.
Because they don't know what the future holds.
Exactly. And when businesses pull back, it can slow down economic growth, which could then lead the Bank of England to lower interest rates to try to stimulate things again.
So it's like a domino effect.
Precisely.
And what about inflation?
Well, trade tensions can also disrupt supply chains, which can lead to higher prices for consumers.
So it's a complex web of interconnected factors.
It really is.
It's amazing how events happening on the other side of the world can have such a direct impact on us here in the UK.
It's a globalized world we live in.
So what does all this mean for our listeners as they think about their financial futures?
It means that it's more important than ever to be proactive and informed. Don't let uncertainty paralyze you. Use it as an opportunity to learn and adapt.
I love that perspective. Turn uncertainty into opportunity.
Exactly.
Now, as we wrap up this part of our deep dive, there's one more big topic I want to tackle. And it's a bit of a wild card.
Oh, really?
Yeah, we've talked about interest rates, inflation, and global trade tensions. But what about the role of technology in all of this?
Ah, yes, technology. That's the game changer.
Exactly. So in the final part of our deep dive, we're going to explore how technology could reshape the economic landscape.
That's going to be fascinating.
All right, so we're talking technology now, and this feels like a whole other level of complexity.
It is a bit of a wild card.
Yeah, I mean, how can we even try to predict how technology is going to impact the economy? It's changing so fast.
It's true that we can't predict the future with 100% certainty, but we can look at potential trends and disruptions.
Okay, so less about predicting specific outcomes and more about understanding the possibilities.
Right.
Can you give us an example? What kind of technological disruptions are we talking about here?
Well, one of the biggest ones is the rise of AI and automation. They have the potential to completely change entire industries.
Yeah, you hear a lot about robots taking our jobs.
Well, some jobs might become obsolete, that's true. But new jobs will also emerge. It's more about a shift in the labor market.
And that shift could have a big impact on things like wages, consumer spending, and ultimately economic growth.
Exactly.
So how does this technological revolution factor into our understanding of interest rates and inflation?
Well, it definitely adds another layer of complexity. For example, if automation leads to higher productivity and lower production costs, it could actually help keep inflation under control, even if the economy is growing quickly.
Oh, that's interesting.
But on the other hand, if technology leads to lots of people losing their jobs, that could hurt consumer spending and slow down economic growth, which could then lead to lower interest rates.
So it's like technology could push things in either direction.
Right. It depends on how things play out.
It's a lot to think about.
It is.
But this is important stuff for our listeners to understand, so they can be prepared for whatever the future holds.
Absolutely.
So what's your advice for navigating this uncertain technological landscape?
I think the most important thing is to be adaptable and embrace lifelong learning. The skills that are in demand today might not be the skills that are needed tomorrow.
That's a good point. We need to be willing to constantly learn and evolve.
Exactly.
Well, we've covered a lot of ground in this deep dive.
Mhm.
From interest rate predictions to global trade tensions to the future of technology, it's been a fascinating conversation.
It really has.
And I hope our listeners are feeling informed and empowered to make smart financial decisions in this ever-changing world.
Me too. Remember, knowledge is power.
That's right. So keep learning, keep exploring, and keep diving deep. Thanks for joining us.
Thanks, everyone.